Welcome to the Explain It podcast. I'm your host, Ingrid Hernandez. Super excited. Look at this. Work hard, be nice to people. Is it that difficult? I am borrowing Kimberly Mashu office today over at the Keegley offices, the sub 2 offices, because this whole week we are doing the No One Left Behind challenge with Pace. And in that experience, we call agents, we tell them, hey, we have opportunities to buy your properties, blah, blah, blah. And then the real work begins, right? Some of that real work includes capital raising, because if you have an amazing deal and you want to keep that deal versus wholesale it, you need money. And so I'm really excited to bring up to the stage Casey Gregersen, who is becoming a really good friend of mine here in Sub 2, because we were in Sub 2, we're an owners club. And Casey has a huge heart. He wants to make sure all of you profit from the problems that you're going to come across. And that's one of the things that's really exciting about joining a mentorship like Sub 2 or Owners Club. You get to be around people who are doing really cool things. So let's give a warm welcome to Casey Gregersen. Let us know where you guys are joining us and what questions you're going to have for Casey. What's up, Casey?
Hey, Ingrid.
Hey, thanks for coming on the podcast.
Heck yeah. I'm excited. Let's do it. I'm excited to see. I know you do a phenomenal job getting people live and actually interacting, so I can't wait.
Yeah, let's go. So Casey, tell us a little bit about what was your, I don't know, 2 or 3 minute origin story that tells us how, and I think from me and you, we come from a W-2 background, and we kind of want to show people that is possible. So kind of give us a rundown of what is your origin story? How did you get into real estate? And then we'll walk through maybe the more evolutions that you've kind of gone through.
Absolutely. So 2010, I bought my first rental property. I was going to school for grad school, actually, at the University of Wyoming. I was going to school for petroleum engineering, and I actually was house hacking. I actually bought my house from my roommate, but my dad co-signed with me because I just had a little stipend. I wasn't making much money back in college, right? But my dad co-signed, and I bought that first property 15 years ago. But I didn't, and some people think, all right, wow, you've been doing it for 15 years, but I actually just sat on that one house, and I went to work in my W-2 for Shell. I moved down to Houston and worked in oil and gas. And I really just held on to that one property for about 5 years. And I was then, where it really changed for me is I was out in the field working on a drilling rig, right? I would go out there for 2 weeks and I have 2 weeks off. But when I was on my 2 weeks, we had all this driving time. We called it windshield time, where we're driving around on the road in West Texas or up in Canada. And I listened to Rich Dad, Poor Dad. And then that light bulb came on for me, because I already had that. I still had that first property, but I wasn't really treating it like a true asset, and wasn't thinking about what I was actually doing. So light bulb came on, and I'm like, all right, I want to get more of these. So that's what I started doing.
That's so awesome. Okay. So what I heard you say is get yourself some quiet time and some thinking time, and realize some stuff about your life. You heard it here from Casey, hey, we actually got started and didn't maximize on that opportunity. And that thinking time really gave you the opportunity to think through, hey, maybe this could be different for you, right? Now,
absolutely.
Oil rig man, how do you transition from dealing with engineering? And the most experience I've had to this, I haven't watched Landman, although I want to watch Landman. For those of us who watched Steven Tyler sing the song in the 90s, what was that movie called? I'm trying to remember.
Oh yeah. Aerosmith. I don't want to, I know the song.
Don't want to close my eyes.
I can sing it. Yeah.
Don't want to fall asleep because I'm missing you. Okay. That song in that movie, was it I don't remember. It was a very apocalyptic kind of name. If you guys can name it on there, please drop it in the chat, because it's going to ruin me, because I can't remember what the name of this movie is. But all I remember was everybody was super afraid of a oil rig explosion. The roughnecks, I believe they're called, that work that kind of business one of the most scariest things to do. So like, where were you in all of that kind of drilling?
You bet. Yeah, I was. And if you guys have seen Landman, there's it's the engineer that's out on site. He's kind of the heavier guy that's got long hair, and he's just like, he's really filthy and gross. But so if you guys are watching this show, you know who I'm talking about. That was more my, well, honestly, that was my defined role by like title, but I was more like Billy Bob Thornton. I was the guy going lease to lease, right, and checking on things. And because that's why I always relate to him. Like they show clips of him on the road where he's driving down these crazy West Texas 2-lane roads where all these huge semis were just flying by you. It was scary, honestly. It was very scary. I'm glad I made it out. But that was me, right? I was out there in the field. But one big thing, Ingrid, and I know I've shared the story with you, but while I was out there, I would go out there for 2 weeks, and it was great because like I had 2 weeks off. But those 2 weeks I was away from my family and kids, and it was in kind of a dangerous setting. Fortunately, I wasn't the guy out on the rigs and in harm's way. My job was to keep them safe and mitigate risk. And honestly, I spent a lot of my roles in the field just purely based on how do we keep people safe. Because one thing, say what you want about Shell, there were a lot of things I didn't love, but they were a safety first company. So anyway, learned a lot about that. But my biggest thing was, while I was out there, I'm like, I don't want to be here forever. There's so many people in that industry that have been there for years, and they've been seeing these ups and downs. Like they did layoffs. Check this out. For like 6 straight years before I left, every year they cut out like 10%. In 1 year, they cut off 40%. We all, 40% of us had to go reapply for our jobs and try to get another job within Shell. And majority of them lost their job. And this was right during COVID. So I hated going through that. And I know a lot of other people were stressed out. Fortunately, I was building my real estate portfolio on the side, so I had a good little off ramp, but most people didn't do that. So that's kind of became my passion, is helping other people create that for themselves.
Yeah. And if you're in the audience, let me know if you guys have a W-2. Say yes or no. And one of the things that I actually struggled with is letting go of what we're calling like the golden handcuffs, right? Because were you paid well, even though there was sort of this like risk of losing your job? Were you paid well through this job that you had?
Yeah, thankfully. And I was having a conversation. I was on my podcast the other day, Rigs to Riches, and I was talking to another oil and gas guy, and he said it well. He's like, they do pay us well, right? Out of college, I had the highest paying job of all of my peers. It was crazy. I was honest. In 2012, I was paid almost 6 figures to start out. It was unbelievable. And when oil was hot and oil was $100 a barrel, like life was good, right? Like we got like our credit cards, our expenses, like we lived the high life, right? But when oil's not so good, it's not so lucrative, and everybody's getting laid off. But yeah, it's definitely the highs and the lows for sure. Boom and bust.
Yeah. Totally. And I came from food service. So in food service, if anybody knows anything about restaurants, literally our mom and pop restaurants that we mostly serve make pennies on the dollar. So they're working long hours. They're working everything they possibly can to have their take home be pennies on the dollar. And so I knew that in food service too. And when the pandemic came, Casey, our whole industry was obliterated because we couldn't eat at restaurants. So many customers lost their business, and I had to lay people off. And same like you, Casey, like real estate provided a lifeline to figure out how do we stabilize and how do we assure ourselves, because life is a risk, by the way, guys. Everything is a risk. Having real estate is a risk. Having a job is a risk. All of it is risky. It's just, which risk do you want to take? There is no safe thing ever. There is no, that doesn't exist. Like, we're not God. We can't control that. Like, there is nothing safe about this life. So we have to figure out, what is it that we want to spend our time and attention and our passion into, and go maximize it. So Casey, what I heard you say is, I am observing that all of these people are in this space doing this thing, and I don't want to do that forever. And then you used real estate as a pathway for your next steps. So walk us through, what does that transition look like for you? I've been out of my role for a whole year. So like March of last year was when I was laid off, guys. I didn't just leave. I was laid off, and I was like, let me catapult and use that as a way to go all in on real estate. What about you, Casey? Like, what did that experience look like?
Yeah, it was an evolution for sure. And to your point of making like it was a highly paid job when it was good, right? And what I started doing, fortunately, was using that excess money to invest it into real estate, and that all compounded for me. But yeah, I really so I built a vertically integrated company. I won't go too much in the weeds, but I built a direct to seller company, and then I built property management in house, and then the last thing I did was built construction, right, and had in house crews. But what a big thing I did, I don't even think I've shared this with you, Ingrid, is like I kept my W-2 for a long time because I was able to bankroll all that with my W-2. So I could, when I fixed and flipped a house, rather than me having to pay myself that $50,000 I just made, that money stayed in the business. I kept living off my W-2, and it allowed me to keep hiring and growing, investing more in marketing and teams and all the systems, right? So that way, come a couple years ago, so I left 2.5 years ago, but prior to leaving, I had built this all up, and I had a really cool gig where I was able to still keep managing it and keep building it. So I was actually going to ride it out as long as I could, but I was similar to you. I actually finally got forced out, which was a blessing.
Mm-hmm. Nice. Well, welcome to the show, Sandy and Elizabeth, as we're learning how Casey transitioned from a W-2 into real estate full-time. And I actually am the biggest fan of that. Like, I believe it's the most risk-averse way of leaving a W-2. And it all really, there is no right or wrong way either. It's all really about what is your, level of confidence in doing this, and what is your uh your risk aversion. So like, I am not a risky gal. Like, I have a family, I have a husband, I'm the primary breadwinner. So saying bye-bye to my job was not like an easy task to just do and then go all in on real estate. There were still bills that needed to be paid. There's still like mouths that need to be fed. So making that jump off of that is not just like a snap, right? So I love how you've described what you did, which was and Pace will say this too, Pace Morby, right? He'll say having a W-2 is a superpower. So when he framed it that way for me, by the time I was let go, I was like, damn, I should have taken out so many more loans while I was still bankable. Like, I think I only took out 2. I should have taken out like 8. How about you? What do you think about that?
Oh yeah. I tell people that all the time. Like, if you are still have your W-2 and feel like you want to jump, well, you don't have to, because that is your superpower. You might want to take that as long as you can, as long as you possibly can. But yeah, to tell you my experience, that was my superpower, because I had it times 2, because I was fixing and flipping. So I had a track record, I had experience. And when I went to a small bank, and this is the other thing I did, is every time I did this early on, it started with one bank. And then by the time I started more deals, like every time I would be looking at, like every spring, for example, I would go to like 5 different small banks, send them all my financials, right? And make sure they got me, they underwrote me, and they were ready to go. And now I built at least 5 new relationships probably every year. So now I've got all these small banks that got to know me. And now that was like, I was the best borrower, right? I had a good W-2, I had experience, and that's what really allowed me to grow and scale my portfolio, right? And use leverage in a safe way, because I was finding deals with cash flow. I was finding deals at a discount. And this might blow your mind too. A lot of people talking about using hard money. Like, I didn't have to use hard money, because I built relationships with small banks, and they knew these little small markets, and I could go and close. Like, one deal I always share, I closed this one deal where the seller's like, I will basically discount this thing to 75% of the value for you if you can close in 10 days, because I'm doing a 1031, and I already know what I'm buying in 10 days. So if I can sell this, I can roll it. So he's like, so you got to close in 10 days. I'm like, all right. I got off the phone, I called my small bank, and I'm like, hey, can we close in 10 days on this little duplex? It's a great deal. She's like, let me see what I can do. And yeah, we closed in 10 days with a small bank and funded that one.
That's
which most
so
people would
awesome.
be like, you can't do that. You'd have to go to a hard money, right?
Right. Well, and let's talk through this for a moment. The fundamentals of investing will always be there if you ever want to maximize what you can do as a capital raiser, as a fix and flipper, as somebody wholesaling and needing working capital. Working capital is like the money you need to keep the engine going, your business going. And one of the things that I've always said on this podcast is take care of your credit score. your credit score and your credit worthiness can do so much more for you than you ever thought possible. And Casey is basically describing to you what does that look like. So the superpower of having a W-2 is the bankability that you do. But once you establish that relationship, once they know you're credit worthy, they'll forget that you had a W-2, because now your other activity is going to be the thing that they go off of. So I agree with you. And Chai has actually exposed a lot of these fundamentals for me. And so we're working on also creating a pipeline of deals in the Midwest. And I believe that's where you're doing a lot of your stuff, because there's so many smaller banks and so many easier ways to prove to a bank that you are worthy of their business credit lines and things like that. So what are some things that maybe, and maybe I just described them, I'm not even sure, because I actually haven't done this yet. I'm actually looking forward to doing this. Like, what are some of the fundamentals that somebody who wants to maybe leverage a smaller bank would need to have and be prepared as you're preparing yourself to become worthy of a bank lending you money this way?
Yes. Oh, that's such a good question, Ingrid. I just talked about this last Friday on Problems to Profits. We were talking about, I call it the 5 C's of like small banking or credit unions, right? The small C's that you want to, the 5 C's that you want every lender that should be thinking about. Okay. So yeah, it's real easy. So the first one is cash, right? That one's easy when it comes to mind. People usually get this one. The bank is going to look at what cash do you have. Okay. As you mentioned, another one, big one is credit. And yeah, you could not have understated that more. Like, that's one I want to start for my kids, because if you, and your credit fluctuates, right? But if you in general take care of it, right? If you, for example, if I've got a bunch of deals going and I've got a Home Depot card that's maxed, because I'm taking advantage of 0%, like my credit might drop all the way from like, I range from like 770 all the way down to like 600, right? Yeah.
Me too. Okay. Yeah. Not just me. Okay. I feel better, because I'm like, my credit cards are maxed right now while we're waiting on these 2 flips to get going. Okay, cool.
Oh,
this was also therapy session.
But then it shoots back up. And then in most banks, and this is the key part, right? Most banks can understand that, be like, hey, yes, I know when you go pull my credit, here's this, and this, but here's where it's going to. Why would I not use a 0% interest Home Depot card? Right. So that's the credit one. Okay. One of the biggest ones that nobody talks about is character, right? Or people talk about it when it comes to maybe PMLs, but when it comes to a small bank, you want to demonstrate your character, what you're all about, right? I'll share a story. Probably not for this one. It's too long, but I went through this deal where basically I could have walked away from this tear down, a house that I was not expecting to tear down, turned into a tear down. And I had to go back to my bank, be like, how do we restructure? How do we make this work? And I was able to sell part of a business and move some money around and make it happen. But I finished that job. And that banker, to this day, I'll never forget the conversation. I'm sitting there in his office and he's like, Casey, he's like, thank you for what you did. You didn't have to do that. Most people would not have. But now every time I go to loan committee to go propose another one of your deals, I'm just gonna be like, yeah, hey, this is Casey. Remember Casey? He's the one that went through that, didn't bail on us, right? And finished the project. So your character, just doing what you say you're going to do, communicating well, is a huge one. Okay. The other one is conditions. They want to look at like the conditions of the market, right? And this could be the condition of a property as well, but typically it's like, what is the condition of the market? And is it like right now, are interest rates high? Are we in a recession? Is it 2008? Like or what's the conditions in that local market too? Are there jobs, right? And then the last ones are, we talked about cash and cash flow. There's actually 2 parts, right? They want to see how much cash you have, and then what is the cash flow of the property, right? They're going to write that. Okay. And then, yeah, I think I hit them 1, 2, 3, 4, 5. Yes.
So let me recap. I've got credit. So what's your credit score and the behavior of that credit score? Because some things can be explained. The character. So, hey, do you say what you say you're going to do? Are you a good person? Basically, based on some of those metrics. Conditions. So how's the market doing? The property itself, maybe, but like, is the bank really? I think banks are tightening up a little bit right now, but is the economy doing stuff that it needs to do in order for you to be successful as the operator? We have cash. So how much money do you have in your accounts, right? And then cash flow, which that one I'm not as clear.
Yeah, cash flow would be the asset you're buying. What are you buying? Does it have cash flow? Can it service itself? Is there profit? Is there income?
Okay, got it. Yeah. So it's more of like a
buy. There's actually a 6th one. Yeah, I lied. There's 6. Okay, because the credit one's actually a bonus one that we've put in. But my other Really important to see, right? We talked about all the little collaterals, all the different one. Okay. Oh, dang. Hold on. Lost. I had on the tip of my tongue. So we talked about collateral. We talked about character. We talked about
Wait, we
condition.
talked about collateral.
Oh, collateral. Yeah, that was it. Collateral. Yes, I knew there was one. So collateral, right? Most of your loans, I mean, unless you're getting like a 0%, unless you're getting a credit card, there's got to be collateral, right? So collateral, they're going to look at the asset. What is backing their money, right? Any loan is going to be based on collateral typically.
Yeah, cool. Well, I went ahead and put it on the screen. I see we have new followers between YouTube and Instagram. We have about 25 people watching right now. So please, like, if you missed the first part, the part that we've started talking about is the part that I think people who want to get started in real estate and like go, forget that there's opportunities with banks and how you'll want to build those relationships. And Casey just dropped some gems for us to tell us, here's the C's you need to be aware of, that you are going to be judged. I understand, God's like the ultimate judge, but you're going to be judged if somebody's going to give you money. And these are things that you have to be aware of, especially if you want to up level your game and start doing really, really fun stuff that I know we're going to get to, Casey, that I am so grateful to be a part of, like the sub 2 community and the owners club community, because I get to learn so much from people like you about your own experiences on things that I want to eventually do. So you tell me when it's the right way to pivot into some of the cool stuff you're doing now, because you had a W-2, you started getting into real estate, you're doing these great deals. How do you evolve into what you're now doing in terms of capital raising and some of the things you got going on?
Yes, a good segue. Because what I was going to add to this, and it parlays perfectly into that, is a quick tip when you guys are talking to a small bank, and then the same thing's going to apply when you go to raise money from private money lenders, is your organization, right? And looking like you're professional and prepared. So when you're talking to a bank, just simply, you can separate yourself by doing this one thing, because the majority of borrowers are not going to be prepared. That bank's going to be chasing them for their W-2 stubs, right? Their pay stubs, their W-2s, their tax returns, right? Their P&Ls. If you're not organized, you're just making their job harder. And these people, a lot of times they are overworked. They have way more loan files than they can actually do. So if you are the borrower that actually is prepared and tees this stuff up, you're going to way separate. You're going to be completely different. And guys, here's the thing too. You're going to have to do it over and over and over. So what I do is I keep this file on my desktop, which got everything I need, and I keep it up to date. I keep my one little thing that'll tell you guys, as you start to build out more assets and more rentals, is what's called an REO schedule, your real estate owned. And this is a really cool way to track your net worth. So I basically just have all my properties, and I have the cash flow, I have the loan amount, and I have the current value, and I keep track of all that. And then that way, if you have all that ready, those are things you're going to have to send to your bank. So keep it all ready. And then my other tip earlier was like, send this out to when you're looking at a deal, send it out to like 5 different banks, because they're all going to ask for the same information. So you might as well just have it all ready and give it to them and make their job easier.
Okay. So these are for your buy and hold decentrally.
Yes.
And if you're dealing with hard money lenders, it's really called like your investor experience, and everybody has their own version of this. So to your point, it's good to just keep one. So the REO schedule, it's your property address, the loan balance, what interest rate?
Yeah, you could put, it could be as detailed as you want. I can share a template that's probably way overkill, but the basics I want is, what you owe, what the balance of your loan, your payment. Well, okay, on the asset level, they want to know what it's worth, what you owe, right? And then on the cash flow level, they want to know what are your rents and what are your expenses.
Yeah, rents, worth, expenses. Okay, this is like a high level, like get this much at least. And so I want to recap so that we walk through things so fast that it's hard. Like I want to make sure people have some tangible things to walk away with. And obviously ChatGPT is, if you're not using ChatGPT, I'll bet you ChatGPT can also give you some feedback to say, if I want to go get a line of credit from a bank, a small bank, what types of information should I have? And then I actually did a Zoom on this, Casey, in sub 2, myself and Jeremy Demers, who's my lending partner. we talked about how to be a better borrower and to be a professional borrower. I think this is the name, what we called it, be a professional borrower. And that way banks are chomping at the bit to give you money because you are able to be somebody that they can process so much quicker because you got all your stuff in order. Literally, it's a matter of being organized. And it doesn't have to be you, Casey. You can have an assistant or an admin, somebody who can help you get all of this together, even if an extension of your bookkeeping. Like if you have a bookkeeper who puts all of this together, this is how it's way easier to work with a bank and really up your game as a professional.
Yeah. Another cool tip is it's a great way to track your net worth, right? When you're buying rentals and you're fixing and flipping, your money is like all over and you're just trying to figure out, am I even moving the needle? But when you keep that REO schedule, you start to see your equity build up. So you might, although the cash in your bank account might not be growing how you want it to, you could see your wealth growing. It's a scoreboard, really.
Yeah, I love it. And that's a fundamental of being an investor. Like I know that we can get lost in the sauce of doing things like through creative finance, which is still a very good thing to do. But I was actually teaching the No One Left Behind challenge folks. And I was like, the thing about creative financing is that you become a hammer. And so when you learn creative financing, everything then looks like a nail to you, where you might need to understand how to do a cash deal. You might need to know what a short sale looks like. You might need to give that seller to a referral to an agent because that's in their best interest. But a fundamental of an investor, whether you're doing one of those tools, is how are you going to grow your net worth with those tools that you now have in place? And net worth, in my opinion, allows you to pivot so much easily. So if you're constantly buying these creative deals where you don't have any equity and you have to make a sharp turn, like what you said, Casey, you had that deal where it was like a tear down. Now you got to go figure out like, how do you sell some of your assets, some of your business assets, whatever you can to make this deal work. If you're constantly buying things that don't have any equity, you will not be able to fundamentally pivot. And so I think it's something that does get lost in a lot of these things that we do, because you can get incredibly creative, which is great, but always keep in the back of your mind, how do you continue to grow your net worth?
Absolutely. It gives you flexibility, can allow you. Well, another thing on that is when you build this equity, now you've got more options for borrowing, right? You can find, again, not every lender, you're not going to be able to go to every bank and get a line of credit behind your, like, because assuming most people that are listening to this are going to not pay cash. We're not the Dave Ramsey crew, right? We're going to use leverage to grow. But if you got some equity, for example, I have my house that I bought 5 years ago after post-COVID, and my loan amount's $400,000. This thing's worth close to $1 million now, and it cash flows, does well. But I've got a bunch of trapped equity in there that I want to get access to, but I don't want to touch my 2.75% loan. So what I can do is I can go leverage that and do a second line. I do this with private money lenders. They'll give me a loan, maybe 12%, essentially like a line of credit in second position, and then I can use that money to get in and out of deals. And why I'm saying this is it's not only a cool strategy to go buy more deals, but it could also help you, as you mentioned, in a tough spot. If you've built up equity, you've got something that you can leverage to go like get you out of a bad spot.
Yeah, for sure. If any of you know like Pace Morby's story, he had built a portfolio, I believe, of like 45 properties here in Arizona, which had a lot of equity in them. And when that guy who did him wrong, he who shall not be named, Voldemort, for all you Harry Potter fans, like that's who that was. That's who that is. And he ended up having to liquidate all of his assets so that he could take care of that 1 million deficit he ended up having to figure out. And if he hadn't done the fundamentals as an investor of growing his net worth, we may not be talking about Pace Morby today. Mm-hmm. So it's one of those stories that will always resonate with me as I start thinking about what assets am I okay with taking on and which ones I'm not, because I want to always have the opportunity to pivot. Okay, so we've had this guy named Gator, which I'm assuming his name is not Gator, asking questions about college. What is the question? Can you discuss buying real estate in college towns and if there's any better idea? So
yes. Yeah, that's a great question. I personally love college town rentals. This, of all the places I invest, this has been one of my best markets. It's the one I've been in the longest, and I've had appreciation, cash flow. Okay, here's the story that will blow your mind. In Laramie, this little college town, we have literally like 0% vacancy. And when I say zero, it's literally zero. So we have this, we call it like the college shuffle. So at the end of July or end of June, I set up all my leases are all a year long. Well, we start leasing we start actually marketing our properties for in like March. I go to all my tenants, say, hey, are you going to renew in March? Or I actually talk to them in like February. And if they say no, I start marketing in March while the students are still there. And I'll renew all my leases either with the current tenant or a new one in that little window. And literally the college shuffle happens on when their lease ends at the end of July 31st. One's moving out, then the next one's starting their lease on August 1st. And I'm trying to figure out how I can get a cleaner in there and figure it all out. But that's just how much demand there are. And if you find the right college town, there's so much demand, and like they literally stack on top of each other. It's awesome.
I love it. I love it. And I love how one of the things, oops, my office light. One of the things that people don't think about is give yourself the best advantage here. Go ahead and have them. And I think this is what I heard you say, Casey. Okay, yes, maybe the semester ends and maybe there's 3 months out of the year where it's empty, but you're not allowing that. You're like, no, we have to do a year lease. If 2 months you're not in it, that's your problem, not mine.
Mm-hmm.
I love it.
Yeah, and I work with them. And we just tell them, hey, I'll help you sublease, or if you want to sublease, you can. But then the onus becomes on them. Then they got to go find somebody. And honestly, so they're sometimes my best marketers. They'll go find somebody else. And then the last piece I didn't even mention is all these leases are almost, I would say, probably 75% plus are co-guarantored by their parents. So when COVID hit, for example, when COVID hit, I had rentals in Texas and Wyoming. I did not miss a single rent payment up in Laramie, despite places where people didn't get rent for a full year in places like California. I didn't miss anything because the parents were all on the hook. They weren't going to lose their credit over a couple of months of their kid but the university being shut down. So it's great. I mean, yeah. Do people worry about they're going to throw a bunch of parties? I mean, again, that comes down to your tenant vetting, and you can have rules but at the end of the day, if they did throw a big party, like the parents are on the hook if they make damages.
Yeah, very cool. Well, let's switch gears to what we had been talking about in this capital raising. And again, what's really cool about these in-person experiences like this week for the No One Left Behind is that you and I got to talk, and I was able to kind of, I first got to really meet you back in December. Was it December?
Mm-hmm. Yeah.
Okay. So in December, we did this thing called the Deal Maker. Casey came to educate us about his fund and kind of get an understanding of like what he's got going. And then he got some mentorship to some feedback to say, here's your presentation, here's what we would do. And then possibly have people also. So that's the primary reason to do Deal Maker. But the second opportunity there is that, hey, you may actually raise capital. So I've been really grateful that I got to ask you about that experience. I got to even give you feedback about that experience because I was like, wow, like, man, you only gave us like this much of how professional you are when you were actually like this much more professional because of the platform that you're using. Should we talk through with this and the audience, like how you're now kind of evolving your real estate experience and professionalizing yourself some more?
Yes. Yeah. And where I'll do is I'll piggyback off of talking to small banks, credibility, being organized. One of the big things I did is I was told this by a high level capital raiser. He's like, if you can't produce a document or have like a vault or some sort of data room where you show all the deals you've done and you can't show HUD statements and like where you sold it for and actually prove it, like then you probably don't have business scaling your capital raising, right? So that's one thing I started probably 2 full years ago. And it took a while to build it all up, but at least I had been doing deals for a while. And I went through and now I have a Google sheet with like 125 plus deals in there. And I think it's up to like 150 now of deals we've done, we've closed on. I put all the numbers in there. I actually put how much the investor put in, when they started, when they got paid back, what the return was. And that way, and it's all backed up by like settlement statements. So that was one big thing I did just to become way more professional. And to the point of the banks, now think about the private money lender, whether it's a family office or somebody who just wants to be a passive real estate investor. I want to make it easy for them to do their due diligence. I don't want to be the borrower that they're chasing, trying to get all their stuff they need, right? There's plenty of those people out there. I want to stand out. So that was one thing I provide. And it's one of the biggest differentiators I now have is they've got all their due diligence right there. And typically that takes care of many objections because they're like, okay, if you're taking the time to do this and I can do that, then you typically come across much more trustworthy.
I love it. I love it. So Casey, when you're doing this, I heard you say two different terms, and I want to make sure that we explain the difference or the fact that they're actually the same, but they're going to hear it kind of used like in different ways. So the word investor versus the word lender. What I heard you say is the investor, right? Like, hey, here's what the investor got back versus if a family office or a private money lender, are they all the same thing?
Great question. I here's what I do. I separated them into debt and equity, right? So on the debt side, I'm always, generally in my deals, I'm always going to try to use some form of, call it senior debt, where I'm going to go to a bank. I'm never going to be able to go to a PML. Maybe at some point I can borrow from PMLs at 6 or 7%, but probably not. So I'm going to go to a bank and do that, right? And then I would say the next tier is, some people call it mezzanine debt. And another easier way to understand it is just a debt in second position. And I'll do a lot of deals with private money lenders where they're in second position, but I show them the underwriting to show them that, hey, even with the first position and the second, the total debt on this is still less than my rule of thumb is like 70%, right? So if they had to take the property back as a second lien position, they could, and there's still a 30% margin of equity, right? So that's the other piece. And then the third one would be, okay, now the third part would be the equity, right? And I also work with investors there to where they're going to help me. They're going to partner with me and my money, and we're going to put it together. And that's going to be the equity for the deal.
Got it. So when you're talking the term investor, oftentimes you're talking about somebody who is invested with you and has an equity position. When you're talking about a lender, you're straight up just saying, you're just debt to me, and I'm giving you a return on your money. And from a perspective of like what acronyms and terminology we use in this real estate space, when we say debt, what we're really just talking about is a loan. It's a loan of whatever that money is. But we like to get fancy here. And if you ever want to get professional, we're using a debt fund, for example. And what a debt fund means is like, oh, we're just lending. We're using there's no equity. There's no like depreciation and stuff like that. No, it's just a loan. Maybe it's secured by real estate, but it's just a loan, and you're going to get a return back on that loan. Cool. Yep. Awesome. And then Dale wants to know, do you only raise capital for real estate?
Currently, yeah, mine are just for real estate deals, and I can go into kind of the different types of them, but I'm able through my fund to actually do oil and gas. I could do whatever sector, even put it into the markets, any type of investment.
You put it into your PMP, I believe it's called.
Yeah. PPM. There you go.
PPM. Damn it.
Yep.
I got it wrong.
Private placement memorandum. Yeah. Mine's built really generic to where I can do any type of investing. And it's meant to be very general. And then I have what's called a deal disclosure on each deal. That way people know, they don't know that, oh, okay, I'm just going to give Casey $50,000 and he can do whatever the heck he wants. No, they're going to invest in a specific deal that has a deal disclosure, so they know what their money is going to be used for.
Yeah. Yeah. Very good. And it's interesting. I love that, that actually triggered the fact that I haven't been focusing on this. So I've been trying to raise $35,000 for a sub 2 deal, and all the debt combined is actually at 70%. So I think the whole debt is around 112,000, and we already have a buyer at 160. Just a matter of using that money, rehabbing the house, and then literally selling it to this buyer that we already have. So I did not think about focusing on what the LTV is, or at least using it as a way to market like, hey, I understand this is a second position loan. However, you are going to stand, like you're still in I'll say like a safer LTV because of the all in that we're in. So that makes sense. Okay,
Yeah.
cool. What's the name of your fund, Casey?
Yes. So we have Bighorn Capital Fund is my parent fund. And where the thing that was going to expand on just a little bit was the kind of back to the different ways to invest. You mentioned investor, right? I've seen people, and I myself, you could sometimes be an investor who just invests in debt. And you could, as an investor, I can invest in a debt deal or an equity deal. And I'll kind of tie this together through my fund. So Bighorn Capital Fund, I always talk about, it's like a parent fund up here. Okay. Now, as I mentioned, I have a PPM that allows me to invest in many different ways. Okay. It's very open-ended, right? Now at the deal level, for example, I have one deal that was on a 45 unit apartment that we're fixing up and we're going to refinance and pay all our investors back. That was debt. And I actually just paid them 15% interest only payments. I pay them monthly. Okay. That was one deal that I did underneath my fund. And before I did that deal, I had like a 7-8 page deal disclosure that went into exactly what we were buying, the interest rate, the security, all the little details in 7-8 pages. Okay. So that was one offering. Now, the cool thing about my fund is it's a customizable fund. And I can have as many offerings as I want. Well, the second one I did was this is one I did. I'm going to give you 3 of them. Okay. So number 2 was at this one I did at Dealmaker, where I did it. It was just a debt fund. I wanted to create basically a private money or a hard money lender for my deals. And also I wanted to be able to lend to other people. So that one I'm offering my investors 10 to 12%. And that one has a lot of flexibility, but again, it's debt, right? That investor is getting a fixed amount and it's secured by actual property. Okay. Now my third one is the equity one. That one I'm probably most excited about and I'm raising for now. This one I'm bringing in limited partners who are part of the equity. So again, they are part owners. They get to share in all the upside if we go crush it. But also if we don't crush it, there's a chance that we don't make as much or make nothing, right? They are part of the risk and the upside. So that's then what I love about my fund is an investor can come in and it's kind of like a brokerage account, right? He can come in and pick like, hey, I want to put in 50K into this debt deal that I know is fixed and I got more flexibility. And then I want to put 50K in this one where I've got a potential to make a 20+% return, right? I want to just obviously diversifying.
I love it. I love it. Okay. Well, you went into brokerage and you're all like, Mr. White Collar over there. I'm all like food buffet. You get to choose which food you'd want. So I love it because
I like it.
Yeah. So Elizabeth asked, can you repeat number 2? Maybe she's asking about your offering.
Yes. Yeah. Number 2 is think about it as a hard money lender or a private money lender. If I don't have this offering, I have to go talk to a hard money guy or go find PMLs, which I do all the time, right? I find investors who are people who will go lend me in second. Often I'm in second because I can use a bank, right? If you listen to the beginning of the call, I spent a lot of time building banking relationships and I'm going to borrow from the bank at 6, 7, 8%. But then I'm going to go borrow from private money lenders and some people call that gap funding, or I call it that's how I'm going to go fund. It's all part of the capital stack. So again, you got the base of this up to maybe 50% or 70% is the bank at like 6 to 8%. Above that, a little bit higher return, you have the second row. It's called mezzanine debt. That's what I was raising for. Okay. I wanted to be able to raise money from other individuals at 10 to 12%. And I allow them to actually get out within 90 days. So that's probably the biggest benefit of this one is they could actually be like, hey, well, let me back up a little bit. I have a lot of people who want to invest and they're like, I'm not ready to invest for 5 years in a typical syndication, right? I want to have flexibility, right? Maybe my kids are going to college in a couple of years. I want to play that safe, or I've got other opportunities that I want to be ready for. So what I do is I offer them to get into the debt one at 10 to 12%, and they got flexibility, right? But again, they have a fixed return. It's a lot easier to calculate. And yeah, people just love the flexibility.
That makes a lot of sense. And this is when you know that you're dealing with the professional guys, because Casey took the time to go invest into where you're going to get all of this in the platform. I don't know if you want to talk about the platform, but
sure.
Every time somebody sets up a fund, depending on what type of fund, it could be an asset-based fund, right? A single offering. That's it. You're going to set up paperwork and all. We love to make lawyers rich, right? A lawyer will go through what this PMP is, which if you guys ever watch Bridger Pennington, who does a lot of capital raising fund information that's in YouTube. And so by the way, I'm a forever learner. And so I'm so excited that I'm learning things that I've never really explored before, and including in capital raising. So the PPM that has to get created for this like asset-based funding or fund, if you do an asset-based one, like it's a one-time, that's it. Like you're setting it up with the lawyer. It'll cost you 15, 30, maybe even $45,000 to set all of these legalese documents up. Or what Casey was describing, where he has a parent fund, and then below it, I almost in my brain, like I think of a squid, like this is the top of your squid, and then below it is the tentacles of all the offerings you get to have. But that squid has to be able to have all these tentacles below it. That means that the at the top level, I believe Bridger Pennington calls it the Bible. He lovingly calls it that. The PPM needs to be generalized enough that all of these little tentacles that come from it are actually covered in that PPM. If it's not, then you cannot offer it as an offering as a part of it. So let's say that Casey's fund was not generalized enough, and now he wanted to go invest into an RV park, but the language in the PPM does not allow him to go do the RV park. Well, now he's got to have a fund separate, or however he wants to structure this over here. So that's important. It's important that however you set up this parent fund is encompassing enough to what you're trying to provide back for people who don't want to be as active investors. And then another point of clarification, if you could, Casey, are we talking about accredited investors? Are we talking about a mix of investors? Like what does your offering provide, and who can invest into it?
You bet. Mine are accredited, but I want to make kind of 2 points to back up what you said. Okay. Number one is passive investors, right? A lot of people, I was actually just had another webinar yesterday talking about this, and I was very clear. Like if you are aggregating money, or you're bringing in passive investors to invest on your deals, or maybe you're just bringing their money together to go invest in other people's deals, if they are truly passive, you have to be very careful, because that could be considered you're basically selling securities, in which case you need to go file and register through the SEC. And that's when you go set up a fund. So very important, if you're bringing in passive investors, people need to hear this, you need to structure it correctly. Okay. Now back to kind of to my fund, to also iterate what Ingrid said is, again, I have a parent fund with a PPM that's very flexible, right? But now I can do different deal by deal. And this is the one thing that if you are looking to raise money, that I wish somebody would have told me, right? 2 years ago, when I first went to the attorney and I'm like, hey, I'm going to pay you $15,000 to draft up all these documents. Well, it was so hard for me to figure out how am I going to set up my offering? Because as Ingrid said, it's like when I first started, I thought I had one, like at least I had to make a decision. I had to set one set of structure, one set of returns. Like I had to basically create a box for what I was going to do, right? And then I had to go package this up and then go raise money for it, okay? But what I found, and this is the tip that everyone should know if they really want to raise money, instead I went and did this customizable fund, which allowed me to go in and set up just one very general. I think Ingrid did a great job explaining the general setup of the PPM at the parent level. And now each time I want to do a deal, I just create what's called a deal disclosure. So very important on the deal disclosure, it goes into the details of what you're investing in. And so and you can provide the proper disclosures, right? That like Hunter Pennington would say, hey, it's like the Bible and you got a bunch of little mini Bibles, right? Depending on each deal.
Chapters of the Bible. Yeah.
There you go. Exactly. But they all got to tie back. But I'm just saying, like, the big point I wanted to make is it allows me to where now each time I don't have to go pay the $15,000 again to set up another fund, because that's what a lot of people do. They'll go pay $15K to set one up, and then they'll go pay it again. I mean, it's typically a little cheaper the second time, but it's not as cheap as with me, where I just go set up another offering. And the last one is the investors. They get to have one K1 from one company, right? It's way easier. Once they come in and put in all their documents and get set up to invest, now they can just pick and choose. They can bring money in or out, and they're going to get one return at the end of the year to hand off to their bookkeeper or whoever does their taxes.
That's so awesome, because every time I do my taxes, it's like to get a K1 process, it's like another cost to my taxes to
Oh, yeah.
to have them done. So if I'm investing with someone like you, I'm not expecting 10 different K1s for the 10 offerings I'm invested with you. I'm just going to get that one K1, and I don't have to worry about all the things that I would have to do from an administrative perspective. That's really cool. So Sandy has all these wonderful questions, which I really, really love. I do have a hard stop today at 2. Unfortunately, I have another meeting after this. But I would love to have you back, Casey, because there's so much that I want to unpack on actually managing a fund that I don't even think we're going to be able to cover on here. But starting one, I think maybe we can take the next 4 or 5 minutes. So Sandy has been asking, how long, time, and money does it take to set up a fund? So we just talked about the platform that you use. Do you want to name the platform? I'm not sure.
Yeah, absolutely. I'd happily to share these. This is, okay, when we talk about doing affiliates, like this is the one where I'm like, guys, they've saved me. They're the ones that have saved me having to do all these different ones. And they've got a cool little mastermind, and they provide a ton of resources. And the CEO is incredibly involved. Well, I'll tell you this is the story. Every time I create a deal disclosure, as mentioned, I have my PPM, and every deal I have, you create a deal disclosure. Well, they provide you the templates, and then the CEO actually takes time to review them with you and QA/QC and make sure you do them. You're setting yourselves up for success. So he takes the time to do it. And the company is Avestor, so just Avestor. That's the company I've used. And I just looked at their pricing yesterday. They charge $18,000 for the initial setup, but you just pay it one time, right? You set it up there, and then their monthly fees are very, very low. So it's actually 0.4% of the money you have like under management. Now, on the flip side, when you do fractional, which again, I love fractional too. I'm doing both. When we could talk about that later too, but essentially I'll give you a nutshell. Fractional is how I work with any type of investor, accredited or unaccredited. Okay. But in Bighorn Capital, that is in accredited investors only. And I had to make that choice when I was setting up the fund. Okay. So anyway, so 2 very different types of investors.
Yeah. Okay. And can anyone set up a fund? Yeah. The answer is yes.
Oh, sorry. Say the last part.
Can anyone set up a fund?
Yeah. Somebody asked me this yesterday. Do you have to be accredited to set up a fund? And I've never been asked for any form of proof to prove that I'm accredited on my fund. So I've never asked that question, but my assumption is the answer is yes. And yeah, if you have the capital to do it. One last thing I was going to make a point on is, it's the 18,000 up front. She also asked timeline. It takes, if you really wanted to condense it, you could potentially do it in 1 to 2 months, but I'm thinking realistically to get it going and start finding investors and getting them through the process, it's a 3 to 4 month process. So that's another one where I mentioned, Ingrid, I've talked to people like yourself and other people. If you're like, hey, I'm bringing in passive investors, I want to make sure I'm SEC compliant. I've actually am working, setting it up to where I could work. You could actually have your investors come up through my fund. Think about this. They come through my parent fund, and then we bring them down on one of the little tentacles, right? Create a new deal. And that deal is separate from all the other deals. And I can actually work with you or the person who's bringing in the capital. They would be called like an asset manager, and they would be able to come in at that deal, keep it all separate, and then stay SEC compliant.
Got it. And then one thing that I learned, and maybe this is something you can solve for as the way that, you get a tentacle worker like myself for you, right? If you co-GP something, then I have to share with you all my lenders' information, like all my investors, right? And so, however, if I'm the fund manager and I choose to invest in your offering through the fund and versus having a co-GP, then I don't share all of my investors' information.
Yes. Right? So 2 ways to do it. You could, if you wanted to go set up your own fund, go invest the money and do it, then it would be completely anonymous. You would just come in Ingrid's fund, right? Do we have a name for it? Fancy name? Anyway.
Squidward fund.
All right. So the Squidward fund comes in. That is its own entity, comes in and invest. It's a fund of funds model, right? That could come and invest on me in a deal. I would never have any access. I would just have terms with you as the fund manager and in my deal, right? That's one option. Or again, if you don't want to go through all that, you could come up through mine. I would obviously know all the investors.
Co-GP.
Exactly. They would come through They would register through my investor portal, but then we would have an agreement to where we'd work them down into your deals.
Yeah. Yeah. Isn't this cool, guys? Like there's so many freaking ways to do real estate, make money, attract money. Like I just get so excited because I did just finish drinking some coffee like not too long ago, but actually, no, I finished drinking coffee like 2 hours ago. However, like this is what's so cool, and what I'm just so pumped about is that there's so much more to learn. And because I'm such an avid student, I feel like I love it. Like I can't wait to learn more from you, Casey. I'm so grateful for our friendship and the fact that you're so open to wanting to teach someone like me so that then we can go back to Owners Club and be able to give them, hey, here's how you can start your own fund. And then here's like the best practices to be a fund manager, which is probably something we need to have our next podcast about, because I'm sure it can feel overwhelming, especially if you're doing it old school. But if you do it new school through like a investor, then that is the way that you want to consider it so that you can mitigate all the administrative burden that's going to be a part of this and really professionalize yourself when you're raising capital. So big shout out to you, Casey, for being kind of a big brother to me. I feel like maybe I'm older than you, maybe little big brother, and helping me kind of learn all these new ways to do this business. I freaking love it so much.
Yeah, it's fun. I mean, I've had all these questions you guys are asking, and you're asking, Ingrid. I was asking myself, and I felt like I was pestering people. Like my attorney was like, I drove him nuts for a while because like, what if this, what if that? But it's like, I got to understand all this so I can set this up right, you know?
That's right. It's how you're going to be a good steward of people's money. And I love it. And this hopefully translates to all of you who want to invest with Casey. So Casey, if somebody wants to invest with you, what's the best way to get a hold of you?
You bet. So I put my, if you guys are watching it on Instagram and YouTube, it's at Casey Gregersen. And yeah, I would encourage people, go like send me, if you guys have any questions, like I'm super responsive. Like I'll answer your questions. I put a lot of this stuff on YouTube, just like Ingrid. And then, yeah. And last thing, if you're just like, if you're like, hey, I'm interested, I want to see what Bighorn Capital Fund looks like. Also, if you just want to see what the back end looks like, we didn't get to talk about this today, but I'll be very quick. If you go create an account, on bighorncapitalfund.com, if you go there, you could create an account for free, and then you could see what it looks like on the back end. And that's a whole nother discussion topic of like the back end is super cool and really user friendly.
Let's have you back, because I want to showcase to people like, hey, we're not just going to take your word for it. If you're a accredited investor, you actually have to prove it. And then once you prove it, then you can actually engage and do all the things. And that's all like SEC regulations requirement. We want to make sure people are educated and that they meet the criteria of what the government says will make you an educated investor. Thank you so much, Casey. So our next podcast is going to be what it takes to manage a fund and how many funds are out there, which is wild. Really, really appreciate you for coming onto the podcast and letting people know you're available on Instagram, you're available on YouTube. Bighorncapital.com, is that what you said?
Bighorncapitalfund.com.
Oh, bighorncapitalfund.com. So maybe
somebody
I'm
took
write
Bighorn
it
Capital.
Oh, I'm sorry. Bighorncapitalfund.com. Okay, cool. Thank you, Casey. So much appreciate you. And then everybody out there, every Wednesday, we are here from 1 to 2 p.m. Arizona time live so that you guys can ask all these wonderful experts like Casey all your questions. And that is why we have this podcast. We want the experts in the space coming here and explaining all these wonderful, wonderful things about how we can help you guys grow your wealth, grow in the real estate or business arena. And so thank you for being here. And we'll catch you guys next week on Wednesday. See you later.